Good morning, everyone, and thank you for joining us today. On behalf of CSCS and the T+1 Settlement Circle Committee, it's my pleasure to welcome you to this webinar on driving market efficiency, exchanges, and the transition to T+1 settlement. We have a strong lineup of speakers today, and that is a very timely conversation as the market continues to evolve. My name is Sefina Akinibagbe, and I will be moderating today's session. Just a few quick housekeeping points before we begin. We are live on Zoom. We are also streaming live on the CSCS YouTube channel. So a warm welcome to those joining us from there. Please keep your microphones muted. Feel free to drop your questions in the chat. We'll take them during the Q&A. A short survey will be shared at the end of the session, and we would appreciate it if you could take a moment to complete and submit. All right, let's get started. To formally kick us off, it's my pleasure to invite the chairman of CSCS PLC, Mr. Temi Popola, to deliver the opening remarks. Over to you, Mr. Popola.
Good morning, distinguished ladies and gentlemen. Can I confirm you can hear me okay?
Yes, we can hear you, sir.
Thank you very much. It's a real pleasure to be here. Let me start first by standing on the protocols that have been established, particularly to welcome the DG of the SEC. It's a real pleasure to be here. On behalf of the board of the Central Securities Clearance System, I am extremely delighted to welcome you to this important engagement as we take the next bold step in the evolution of our capital markets. Today's session is not just another stakeholder webinar. It represents a continuation of a deliberate and accelerated journey toward greater market efficiency, resilience, and global competitiveness. Let me start by acknowledging the leadership of our regulator, the Securities and Exchange Commission, led by Dr. Imomotimi Agama. We call him the Digital DG, as well as the dedication of the T+1 Settlement Cycle Implementation Committee and all trade associations whose collaboration continues to drive progress across the market. Of course, let me also thank my colleagues on the NGX side, Jude, Femi, and all of our colleagues that help us to drive things at the NGX. As you're well aware, the Nigerian capital market only recently transitioned from T+3 to T+2. This was in November 2025, about 6 months ago. It is therefore particularly noteworthy and indeed commendable that within such a short period of time, we're already advancing toward a T+1 settlement cycle. This pace of progress reflects the strength of our market infrastructure, the effectiveness of prior reforms, and the shared commitment of stakeholders to continuous improvements. This is further reinforced by the global benchmarks, as we saw recently with the FTSE Russell reclassification of Nigeria to a frontier market, which recognized, amongst other improvements, the progress in our market efficiency and post-trade reforms, such as the transition to T+2. The transition to T+1 is a natural progression in our market developments. It will further reduce counterparty risk, improve liquidity, accelerate capital recycling, and enhance the overall market efficiency. More importantly, it positions Nigeria alongside leading global markets that have embraced shorter settlement cycles to strengthen investor confidence and reduce systemic exposure. At CSCS, we remain at the core of this transformation. Building on the successful implementation of prior reforms, we have continued to enhance our clearing, settlement, custody, and reporting systems to support an even greater shorter settlement cycle window. Our focus remains on ensuring seamless post-trade processing, operational resilience, and settlement finality within this framework. It's a very good opportunity also for me to say thank you to many of the people at CSCS, both now and in the past, who have worked tirelessly to get in the market to this landmark era. However, as with previous transitions, technology alone will not determine success. The effectiveness of this will depend on the readiness and the alignment of the entire ecosystem of exchanges, brokers, custodians, registrars, fund managers, and investors. This is why engagements like today's are critical. They serve as a platform to deepen understanding, to address operational considerations, and to reinforce the collective responsibility that is required to ensure a smooth transition. As we approach the go-live date, I do please encourage all stakeholders to please build on the momentum from the T+2 transition. Let us please strengthen our internal processes, enhance liquidity planning, and maintain proactive engagement across the entire value chain. The compressed settlement timeline demands greater precision, discipline, and coordination from all participants, and I have no doubts that we can do this together as a market. Let this session serve not only as a forum for dialogue, but also as a call to action, to sustain the pace of progress, to deepen collaboration, and to ensure that no segment of our market is left behind. In closing, I reaffirm on behalf of the Board of CSCS and management, CSCS's commitment to working closely with the SEC, the exchanges, and all market participants to deliver a seamless and successful transition. I'm confident that through our collective effort, our capital market will once again rise to the occasion, setting a new benchmark for efficiency, resilience, and post-trade excellence across the region. I want to say a big thank you again to everyone who has joined this morning. I wish you all a very, very successful dialogue. See you also. Let me thank the team, and look forward to today's deliberations. Thank you.
Thank you, Mr. Popola. That was a very clear and strong tone for today's discussion. I will now invite the MD and CEO of CSCS PLC, Mr. Shehu Shansali, to deliver the CEO's address. You have the floor, sir.
Thank you, Safina, and thank you, everyone. I also want to stand on existing protocol, like my chairman just said. And I also want to use this opportunity to also acknowledge and welcome our DG of the Securities and Exchange Commission, my chairman of CSCS, my colleagues at CSCS and the NGX, and also, most importantly, members of the committee of the T+1 that have gotten us to this place so far. So thank you, everyone. And I also want to say welcome to everyone. The transition to T+1 settlement is not simply a technical adjustment. It is a structural redefinition of how risk, liquidity, and capital efficiency are managed within the Nigerian capital market. For Nigeria, we must say that this is a strategic imperative. It is about ensuring that our market infrastructure remains globally competitive, resilient, and capable of supporting the next phase of market growth. This transition is being championed under the strategic leadership of the Securities and Exchange Commission, SEC, led by our DG, Emomotomi Agama, whose vision is defining the structure, efficiency, and global positioning of the Nigerian capital market. At the center of this transformation is the Central Securities Clearing System, CSCS, not just as an enabler, but as the architect of the post-trade evolution required to make T+1 successful. Nigeria's move toward T+1 is not happening in isolation. It is the result of a deliberate and progressive reform journey. The successful transition from T+3 to T+2 demonstrated that our market can adapt to structural change, delivering improved liquidity, reduced settlement risk, and stronger investor confidence. More importantly, it provided critical lessons in stakeholder alignment, systems readiness, and risk management. At CSCS, we have taken those lessons and applied them in designing a more robust and forward-looking approach to T+1. The rationale for T+1 is very clear. Shorter settlement circles reduce systemic risk by narrowing the window between trade execution and settlement. They enhance liquidity by enabling faster market capital redeployment, and they improve market efficiency by reducing friction across the trade lifecycle. But perhaps most importantly, T+1 ensures that Nigeria remains aligned with global market evolution. Therefore, T+1 is not a speed upgrade, it is a structural upgrade. Now at CSCS, our approach to T+1 is built on 3 pillars. One is automation. We are eliminating manual friction through API-driven integration and straight-through processing. This allows transactions to move seamlessly from trade execution to settlement. 2, connectivity. We are strengthening integration across brokers, custodians, and settlement systems, enabling near real-time data exchange. Our alignment with global messaging standards, including SWIFT, will also improve cross-border efficiency. And 3, visibility. We are enhancing transparency across the trade lifecycle. For example, the settlement notifications can now be disseminated within 30 minutes of post-trade allocation, giving participants earlier clarity and better control over funding decisions. Beyond these pillars, we have upgraded our core settlement platform to improve speed, scalability, and resilience. We have introduced tools such as the post-trade allocation portal to address operational challenges while preserving market discipline. And we continue to expand our digital ecosystem through participant portals and API integrations. Now, the market reality is that T+1 naturally compresses timelines and increases operational intensity. Our responsibility is to ensure that this compression does not translate into instability. That is why we're investing in resilience, conducting rigorous testing, and strengthening monitoring frameworks. We're also working closely with stakeholders across the ecosystem, including the regulators, exchanges, brokers, custodians, banking, FX markets, and other stakeholders to ensure alignment across the full trade lifecycle. Now, ultimately, T+1 requires a shift in mindset. It moves the market from sequential processing to parallel execution, from manual intervention to automation, and from reactive funding to proactive liquidity management. This is not just a systems upgrade, it is a transformation of how the market must operate. Now, in closing, I want to add that ultimately, T+1 is not about doing the same things faster. It is about building a market that is more efficient, more transparent, and more resilient. And at CSCS, we see this as part of a broader journey towards a fully modernized and globally integrated post-trade ecosystem. The success of this transition will not be defined by speed alone, but by the confidence it inspires in the Nigerian capital market. And that is the standard to which we are all committed. So I want to say thank you again to everyone, and thank you, Safina. Thank you.
Thank you so much, Mr. Shansili. That was very insightful. So now we move into the presentations. Our first speaker today will be speaking on preparing the OTC market for T+1, operational readiness, and market coordination. Please join me in welcoming Mrs. Chinwedu Eke, who is representing Mr. Lunge, the MD CEO of NASD PLC. Over to you, ma'am.
Hi, Sabina. Thank you very much. Good morning, everyone. I would like to stand on existing protocol. CEOs of exchanges, CSCS PLC, capital market operators, ladies and gentlemen. Safina, please, can you confirm, can you allow me to share my slides?
Yes.
Can you confirm you can see my slides, please?
Yes, we can see your slide.
Okay. Good morning, everyone. I bring you greetings from our MD, the Managing Director of NASD PLC, Mr. Egwahide Longe. So my discussion today is to share with you the OTC's market readiness on the transition to a T+1 settlement cycle. As the previous speakers have mentioned, they've done a very good background for this presentation. So it's the move to a T+1 settlement cycle is in line with the mandate of the Securities and Exchange Commission and the Capital Markets Master Plan to align the Nigeria capital market with global best practices, enhance efficiency, investor confidence, and market competitiveness. My slide would give a brief rundown of OTC's market performance year to date, a brief rundown of our products, and do a brief recap of, as the CEO has mentioned, we moved from a T+3 settlement cycle to a T+2 settlement cycle in November last year. And then I'll talk on how NASD is ready for our transition to a T+1, and then close with a highlight of what you are to expect come May 29th when we move to T+1. Okay, so NASD's market capitalization stands at approximately 2.4 trillion naira, which is about 1.7 billion in dollars. Capitalization reflects the overall size and valuation of companies listed on the OTC market. Our index has grown year to date by 13.82%, signaling a positive market momentum and performance across the listed securities on the market. Our value traded year to date is approximately 18 billion, and this demonstrates sustained trading in secondary market activity. Our commercial paper listings commenced in Q4 2025 with a current total in short-term debt instruments. This affirms our role to support corporate funding and liquidity management. On the right side of my presentation, we have an overview of our products. So NASDs continue to evolve beyond traditional trading through multiple platforms, and this aligns with our vision to strengthen both traditional OTC function and expand into digital private and alternative financing channels. So by a way of recap, settlement cycle represents the interval between trade execution and the final transfer of securities and funds. As mentioned last year, November 30, 2025, the market transitioned from a T+3 to a T+2 settlement cycle. Now, this milestone aligns our market with international best practices, reduces counterparty and settlement risk, and strengthens our overall market integrity. And as a nation, as a market collectively, it also underscores our commitment to market modernization, resilience, investor protection, and continuous improvement. So the meat of the discussion, this slide is going to tell you NASD's readiness to support an accelerated settlement environment as we position the market towards a T+1 capability. Now, at the core of our market is our NASD ATS engine. It is already fully capable of supporting a T+1 settlement cycle. What we've done is we've optimized our system configurations and parameters to ensure seamless alignment across the timelines that have been set for trading, clearing, and settlement for T+1. The important things to note is that all our critical touch points, which includes our mobile app, our APIs, and our reporting portals, have all been fully synchronized to ensure consistent and reliable user experience across our ecosystem. Now, beyond internal readiness, we've also conducted an industry-wide simulation exercises to validate that end-to-end, we are ready for T+1 settlement. All of this was actually done to confirm to us and to the market that the ecosystem is robust, operationally efficient for all key participants and all our participants to operate effectively within the shorter settlement window. On the post-trade side, we've also reconfirmed that all our required integrations and data sharing protocols with the CSCS and other key market participants is streamlined for near real-time exchange of trade data, which is a very critical requirement for efficient processing within the T+1 settlement window. I would use this opportunity to thank everyone, the CSCS, the SEC, the CSCS for leading this project. It's actually a collaborative effort of everybody, participating institutions, the custodian community for pushing this through. I would also want to thank the Settlement Cycle Committee led by Mrs. Onome. Thank you everyone for the hard work to get this done and position our markets forward. So this last slide in conclusion would clarify what remains unchanged, what will change as we move towards a shorter settlement cycle on the OTC market. Firstly, it's important to emphasize that on the NASD side, our market access remains exactly the same. Participants will continue to use existing channels. Our trading rules remains unchanged. There will be no alteration to how trades are executed and governed. Our trading hours will remain the same. So in summary, from a front end and participant perspective, trading experience will remain consistent across all our channels. What will be changing fundamentally is from the market perspective is that our settlement time frame is now shortened to a T+1. And what this means is that completion of trades, exchange of cash and securities will occur faster within one business day. Now, what will be the implication for our investors and market participants or market operators on the OTC side? We expect that participants will ensure that all faster post-trade processing requirement at all levels is validated and ensured. Then we expect timely funding of securities and timely funding of cash and then securities. So operationally, summary, nothing changes in how you trade. What you expect going forward is that trades will be completed quickly to make the market more efficient, reduce risk, and enhance liquidity. So thank you very much for your attention. Back to you, Safina.
Thank you so much, Mrs. Chinwe-Duike. That was very practical inside there, especially around coordination and operational readiness across the OTC market. Thank you. So please feel free to share your question in the chat. We'll pick that up during the Q&A session. So I'm going to move on to the next speaker. Our next speaker is the CEO of the Nigerian Exchange Limited, Mr. Jude Chiemeka, who will be speaking on exchange readiness for T+1, strengthening the market infrastructure and trading alignment. Please join me in welcoming Mr. Jude Chiemeka. You have the floor, sir.
All right. Good morning, Safina. Good morning.
Good morning.
Ladies and gentlemen. If you will allow me to share my screen.
So are you able to share your screen?
I'm not able to do that. I don't know why.
Okay, we'll fix that.
Just can you try again?
We can see your screen now.
Okay. All right, thank you. So we'll just go over the introduction has been done already. We'll just talk about our equity market performance, where we are now. So from the settlement cycle that we currently have, which is T+2, the work really has been done, what the committee has done, so the transition to T+1 is in clear readiness for the work that has been done. Next slide. So you have to keep up with me. I'll just walk from this side. So the current market cap that we have, just a brief background of the market statistics. We do have a multi-asset exchange, which encompasses both equities, fixed income, as well as ETFs. If you look at our current figures, year to date, the equities market has a market cap of over 110 billion US dollars, and the market has done 52.4% in terms of the index return, compared to what was done last year, which was 51%. And on the fixed income side, the market cap is over $39 billion. On the ETF, market cap is around $68 million. And average value of trades at the moment is at $26 million. So this is really the underpinning background for transitioning into a T+1 settlement cycle. Here, we'll just look at the operational dynamics and why we're transitioning from our current T+2 to T+1, which really aligns our market with what we see across various international markets where we play. And a lot of shareholder engagement have been done, coordinated by the CSCS and NGX to ensure that there's alignment. And what this modernization will do for our capital market is really to help drive greater efficiency, help reduce risks, settlement, and as well as strengthening more confidence in the part of investors and supporting long-term sustainable growth for the market. So why T+1 now? If we look at the way the market has performed and how the configuration of the market has really de-risked itself from international investors, and we now have a more larger participation from the retail investors that operate in the market, as well as the market is now more aligned with domestic institutional participation. So the reduction of counterparty risk is a key reason, improving the liquidity of the market, and in line with the current FTSE Russell Frontier Re-Inclusion Index of our market, where we're now classified as a frontier market, which has its imperative. But given all the work that we're doing, our aspiration is really to emerge as an emerging market, and that will require us to move from $26 million that we currently trade to at least $100 million. So we need to have more investor confidence so that we can have more participation. More importantly, to make our market more competitive. So from an infrastructure readiness perspective, there are three sides to it. One is the trading system alignment. Our SGen which is world-class trading system that we use, is well configured to settle transactions on a T+1 basis. So we'll just do the necessary alignment to ensure that the trading license holders, retail investors, and institutional investors are able to integrate seamlessly. Also, in terms of how this has been approached, there have been a lot of industry-wide testing, working with other numerous stakeholders in the market to ensure that the proactive steps required to align the market for a T+1 settlement is not compromised. And the last bit is really around the post-trade integration, which really after trade, given the fact that our trading time has now been increased from 9 a.m. to 4 p.m. So we're also shortening some of the activities that occur at the back end to ensure a seamless transition. Supporting market operators through transition is a key imperative that we'll continue to do, working with the brokers, trading license holders to ensure that even their online platforms that is now accommodating quite a number of retail investors are well provided for the institutional clients and custodians. That alignment is also to ensure speedy updates that are received in terms of how the trading occurs and post-trade information are passed. And for the retail investors, is really around market education. We have started that. We'll continue to do that to ensure that the retail investors have the right information and knowledge to be able to take advantage of this shortened settlement cycle to maximize the benefits coming from investing in stocks. And the last is really registrars and transfer agents to ensure, since shares are registered in Nigeria, to ensure proper education so that shareholders understand the implication and how it affects their holdings in the stocks in the market. It's very important to point out that our market is a pre-funded market. And so retail investors need to understand that they need to pre-fund their activities because of this shortened settlement cycle to avoid any risk of settlement. What are the impacts this T+1 settlement cycle will have? I mean, it really helps to reduce the risk associated with settlement, market counterparty risk, which is why it's important for retail investors to pre-fund their trades and for institutional investors to also ensure that their settlement part, especially with their banks, are in order to avoid any settlement risk. This will help also enhance market efficiency and liquidity and encourage more investing in the market, as well as investors' reaction to all the various information regarding the market because of the shortness of the settlement cycle. So they now have the right platform to be able to maximize their investments within the market. And this will also help boost more confidence. So we believe that adopting this framework, which demonstrates our commitment to evolving and meeting the expectation of modern and global investors, we'll probably see more investors, especially Nigerians in the diaspora, and as well as other non-Nigerian investors who have seen the performance of the market spike since the beginning of the year, having done over 52% as against 51% the total market did last year. And the last bit is really to align with global best practices. I mean, what is global best practices? It's really more around ensuring that our market remains more competitive, more attractive, and in a seamless, technologically driven manner for investors who want to invest in our market to find the right path, and at the same time, reduce all the risk associated with settlement, clearing, so that the market becomes a lot more efficient in the way we operate. So from a readiness perspective, the NGS is quite ready. I must, at this point, thank all the various stakeholders that we have worked with, particularly CSCS, and a huge thanks to the committee members who have worked tirelessly to ensure that this initiative is successful. So from building a future-ready market, I think this is done collaboratively. It's not something that we do in isolation. The ecosystem is quite large, so we see leadership from our side because of the trading infrastructure that we provide, which is world-class. We also understand that the Nigerian capital market structure itself, infrastructure, will be ready to adopt this. And the nature of the collaboration for success that we do, we certainly ensure that this transition hinges on the collaboration readiness of all market participants, such as the regulators, financial institutions, brokers, custodians, and investors, both retail and institutional investors. And this is really a springboard, like has been mentioned here, for future innovations, because it will really allow more products, more market segments to evolve naturally. So we must thank the SEC for their understanding of the dynamics of the market and how the market can really leverage technology to encourage more trading, more liquidity. And this will certainly make way for more listings in our market, as issuers will then see the attractiveness of the market, information is well disseminated, and transactions are settled in a manner that
We lost you for a bit.
confidence.
Sorry, lost you a bit.
That's the end of the presentation, and we'll be happy to take questions at the end. Thank you very much for your time.
Thank you, Mr. Chimika. Please, I hope I'm audible.
Yes.
Yes, you are.
Okay, good. Because we lost you there a bit, you know. So thank you so much. And it shows that your presentation has really reaffirmed the commitment and readiness of NGX to support the seamless implementation of T+1. So thank you, sir, for that. So we move on to our next presentation. And our next speaker will be speaking on advancing market efficiency, commodity market readiness for the T+1 settlement cycle. Please join me in welcoming Mr. Akinshola Akeredolu Ale, MD CEO of the Lagos Commodities and Futures Exchange. You have the floor, sir.
Thank you very much. Good morning, everybody. I'd like to start on the existing protocol today. My paper is going to be focused on advancing market efficiency, looking at the commodities market readiness for the T+1 settlement. And the first thing I'd like to say is that I think the commodities ecosystem are going to be the major beneficiaries of this T+1 transaction cycle. And also it's going to be a catalyst for the growth of the commodity space. Because unlike the equities market and the fixed income market, the commodities market is more sensitive to FX movements globally, price of commodities globally. And as such, the transaction cycle for settlement of trades also needs to be closer to T+1, if not T+0, which we might still be seeing in the future. And for the markets that are going to be on the sides that in the global space, a lot of them had already transitioned them to T+1. So effectively, by the way of engagement, the market readiness of the commodity space in Nigeria is going to be in alignment with whatever is available globally, internationally, for us to be able to be trading at the same power level as other ecosystems. So I will just be touching on briefly the global financial markets and how they are rapidly transitioning to T+1 settlement cycles, which is already almost like 60 to 70% done in other climes. We'll be looking at what are the benefits, which some of them have been spoken about earlier. We will speak briefly about the counterparty risk, which is very key. The benefits of liquidity lag, which will be covered there, and the capital lockup, which will be freed up in the commodity space and in other parts of the market. Then also for the commodities market, we'll see what other markets are doing in the petroleum liquid space, in the gold space, in the derivatives space, and how LCF is trying to align to global best practice. In global best practice, naturally, a lot of things that has to do with the commodities trading at the end of the day focuses more at the end of the day on derivatives. And the derivatives market always has and requires a closer transaction cycle closure. for liquidity purpose, for margining, for variation margin position, which I'll discuss later briefly on. Now, the global financial markets are moving faster, safer, and more efficient towards the efficient settlement cycle. So I must first of all commend the Central Securities clearing system for moving us closer to these new realities. I must commend also the parent institution and the lead institution NGX also supporting this particular ecosystem. Effectively, what we're doing here is that we're staying at the forefront now in Africa as the largest capital market in Africa now, and the one that's going towards modernization in what we're doing in way of alignment with global best practice. So as we move towards efficiency and transparency, I will just shift my focus more towards the commodity space. The equities market has been spoken about. The OTC market has been spoken about. I will focus more on the commodities markets. In the commodities market in the global space, global best practice in the global space. In the United States, Canada, Mexico, Argentina, all of them are already live for T+1. India has already fully implemented T+1 across all the equities markets. The UK and European Union are targeting 2027 to cover up to about 60%. And then this all covers almost about 60% of global market capitalization. So effectively, a better part of the markets now focusing on the capital markets from the angle of T+1. Now, what are the benefits that we see immediately? And we're very, very happy to be associated with the Central Securities and Clearing System in this particular space. The first one is the counterparty and settlement risk. For the equities market, you can do T+3, you can do T+2, but for counterparty and settlement risk for the commodities market, because of the FX fluctuations and sensitivity of FX in the global space, sensitivity of pricing for commodities in the global space, a 3-day cycle before creates a very big gap between the Nigerian markets and the global markets. T+1 brings us closer to it. For example, if you want to look at the gold space, most of the people that are trading gold as a commodity are already closing on doing T+0, but T+1 is still very good for us because when you trade gold at the end of the day, it's almost like trading currency on its own. That's the first thing. Then the second thing is for people that want to move funds immediately, quickly, doing trades from one asset class to another, there's going to be easier, faster capital movement there. And for people that are do what we call collateral management and then margin trading also, there'll be more collateral efficiency to the extent that if people want to trade on daily basis and move their assets of values to another place to avoid volatility in the FX space, volatility in the commodity space, and any other capital market instrument, T+1 makes it better and quicker. Now, I've seen the trustees, the nominees, the custodians being here, and they know also that T+1 is going to make it easier for them to be able to settle their trades immediately. And we have an existing arrangement that supports what we call direct cash settlement already to support this space. So commodities space also now will have improved liquidity, and there will be market, bigger commodities space in the market. What this does is that investor confidence will grow and will be doing better. Now, for this particular T+1, the major enhancement that I see is the issue of the two-way quotes. You know, when you talk about price discovery and transparency, the two-way quote takes effect almost immediately because now when you have T+1, let me give a scenario whereby you had a T+3 position before in the commodity space, and there's an announcement on a Friday about the results of climate, or result of harvests, or results of macro issues in certain locations on a Friday to a Monday, and the other parts of the world are creating and doing trades continuously to settle trades. If we have to wait for 3 days, we're going to have issues on the two-way quotes. Now, this T+1 also will bring in support for proprietary trading. Effectively, proprietary trading will be better because liquidity will be better for people that want to do proprietary trading. Straight settlement can happen and go back immediately for whatever we're doing. And what that does is that risk management becomes better for us to be able to have stability by way of being able to predict when the funds will settle and when investors will be able to take position on it. Now, on the issue of claim members and marking to market, you know, because for risk management, some institutions want to market on daily basis. If you have a T+3 position, mark to market becomes more difficult. But for T+1, it makes it easier for people to do mark to market. And as we go further, you see other opportunities that other people are using T+1 to do. They'll be able to manage their variation margin very well. They'll be able to manage their margin calls very well. They'll be able to manage their proprietary trading very well. This is applicable whether in the fixed income market, in the commodities market, in the equities market, or in the derivatives market. And the commodities market is more sports market and the derivatives market. T+1 is a welcome development. That's why I'm mentioning that we are one of the major beneficiaries for T+1. Because in the time past, for some people that wanted to trade gold, they felt that T+3 was too long for them for their gold trades to settle. But now that we're at T+1, it's a more friendly settlement arrangement whereby people can get value immediately and they can deploy their assets into other assets where they're doing trading. Now, what is the role of the commodities exchanges as I've been mentioned earlier? I'll first of all just go straight to my right side to the issue of the various markets there in the commodity space and what they're doing. If you look at the CME group, they are T+1, and then that supports their margin settlement. It means that you can do margin trading, you can leverage their trades, and you can settle trades very well. And then for the ICE exchange for energy and soft commodities, the variation margin, which is the margin that has to do with cash settlement and collateral management also. T+1 supports it. They're waiting for the third day before you can settle all those trades. And for the Indian market, the commodity space, they've always been in the T+1 arrangement. And for the MCX for India, because of the mark-to-market settlement arrangement, T+1 is supporting it. And the London Metal Exchange is the same thing. So effectively, this is something that's already existed in the global space that we are trying to go into. And it's going to support and facilitate, like I mentioned earlier, transparent price discovery, risk management through derivatives, and enabling the commodity trades and financing, particularly the sports markets. But the financiers to be able to support it when they know that there's a bid between the T+3 to T+1, when the money is there, will settle through them. And it will make it easier for the commodity producers, traders to be able to participate in that space. This will assist us to function better, faster, and have a more reliable settlement infrastructure. Now, let's look at the impact of what this will do in each case for the commodity space now. In the oil and gas space, in the gold space, in the solid metal space, in the agri space, and the oil sector space. For the oil and gas space, there are some instruments that are highly liquid and highly volatile. In the crude oil, that there are always responses, there are always movements on daily basis, on hourly basis, in some cases, in response to so many global and macro issues. What this T+1 will do is that it will reduce exposure to price shocks. It will enable real-time hedging for people to be able to make adjustments immediately, both morning trades, afternoon trades, and late day trades also. And this will make it easier for critical people, the traders, the refiners, the government, the subnationals, to be able to take positions on daily basis and make adjustments in their portfolios on daily basis. That's one of the things that T+1 will do. In the gold space, gold has a high frequency trading level. And that means at any point in time, a movement of gold upwards by 5% or 3% upwards and downwards can go a long way for people that want to settle trades and for them to know that they have been able to do a proper trade. For you to now drag this for T+3 3 days was a disadvantage to people that wanted to do the trades. So now we have a faster space whereby people can now do faster arbitrage between the sports market and look at what the futures market are doing, and then to reduce the exposure to price volatility that I mentioned earlier. And of course, there will be improved liquidity for the banks and institutional investors, particularly the pension funds, the custodians that want to participate in this. It means that on daily basis, at the end of the trading, they can be able to take decisions, review their portfolios, and book different transactions for the next day for their brokers to execute. And for other solid metals that like lithium, tin, etc., with the increasing demand for this in the global space, one of the major issues are the fragmented supply chains, illiquidity in the emerging markets like ours. Now, when the T+1 comes in and they can see that they can have faster trades and improve investor participation in the space, and there's price discovery, it makes it easier for us to be able to say that we're in the global space in alignment with global best practice for us to participate. I'll take agriculture last, and I'll just talk about one of the major income earners for the Federal Republic of Nigeria, the oil exports, which is very, very revenue sensitive and is very, very dependent and linked to the FX space. The FX space can have reactions on minutes, seconds basis, not to talk about 24-hour basis. Now for T+1, there's going to be faster FX conversion cycles. There will be reduced settlements risk in export contracts, and there will be improvement in the integration with the global trading platform. In the global space now, there will be an integration that's easier instead of a T+3 position. And the one that is the normal space that we are very, very used to, the agri space, that's very, very seasonal and very, very price sensitive. I mentioned earlier, there could be news overnight on harvest, there could be news on rains, there could be news on so many things. The faster settlement supports farmers' cash flows, improves financing cycles, the banks understand it better, and it will also reduce post-trade inefficiencies, which the banking sector is always complaining about. So T+1 actually is a welcome development, particularly for the commodity space, as it will affect also the equities market and the fixed income market in a very, very positive way. So what are we doing to transform this market? We have spoken about market liquidity. We've spoken about improved commodity financing. We've spoken about stronger institutional participation and enhanced integration in the global markets. What are at us on our own side? What are the things that we're doing at Lagos Commodities and Futures Exchange? The major thing that we're doing is that our focus has been on how do we create that alignment with the Central Securities Clearing System. I want to congratulate them as Central Securities Clearing System for the certifications that they have and the zero glitch position for over 25 years or more that they've been trading. It's been giving us a lot of leverage when we discuss depository within the international space, because the trusted platform is a platform that's very, very efficient, and it's now moving to T+1. And especially, I want to thank the regulator, the Securities and Exchange Commission, SEC, that has been implementing this, has put it at the forefront in setting the committees together, and the 10-year master plan implementing it properly. Now, so this supports what we have been doing. Now, our clearing and settlement efficiency is going to be improved. Now we're going to have net settlement for gold trades and other trades. And for the preparedness of the stakeholders in the ecosystem, because the commodity space is a new space whereby we have new people coming into. We have been having engagement with clearing members, brokers, and of course, in support with the CSD, that's the Central Securities Clearing System, we've been doing a lot of engagement to be able to prepare ourselves for this transition to T+1. And for the trading system optimization for faster transaction, we have upgraded our own trading system. For that, we have that will improve post-trade reconciliation that was supposed to be a longer period than we're going to be having end of the reconciliation now. This will support what we're doing and enhance properly the risk management monitoring framework for global people that are looking at the country's commodity space, our capital markets, and even the regulator also to be able to look at what we're doing in that space very well for risk management, and for everybody to be able to mark to market, to do valuation of collaterals in their portfolio, and to know whether they should do a margin call, a margin trade, or how do they monitor the risk in an ecosystem there. All these are things that we have been able to put in place, and we've done the operational testing, we've done the simulations to be able to support this T+1 arrangement. I'll conclude, sorry to have kept you that saying that the success of the T+1 framework depends, like we have done today, and I want to thank CSS, on the collective industry commitments, because every capital market part is interwoven with each other, and they are interdependent with each other. We've discovered how the FX market, the fixed income market, the equities market complement each other to be able to grow bigger capital markets. So we are committed to strengthen the market infrastructure, supporting the CSD, Central Securities Clearing System, supporting the stakeholder readiness to be able to build our own space, which is like a new greenfield, and which we are going, and also to drive innovation in Nigerian commodities market. Together, we are advancing market efficiency and changing the future of Nigeria's capital market and commodities market. Ladies and gentlemen, thank you very much for listening to us at the Lagos Commodities and Futures Exchange today. Thank you very much.
Thank you, Mr. Keridolu. That was very helpful, especially in highlighting the role of the commodities market in this transition. Thank you. Very helpful. So now we're going to go into the practical and the technical overview of market readiness and implementation. Please join me in welcoming Mrs. Onome Komolafe, Divisional Head, Business Services and Client Experience at CSCS PLC. Over to you, Mrs. Komolafe. Thank you.
Thank you very much, Safina. I hope my audio is clear.
Very clear.
Okay, I'll just very quickly go on to share my screen. Good morning again, everyone, and standing on existing protocols. I'll be taking the presentation on T+1 exchanges and the transition to a faster settlement cycle while driving market efficiency. Before going into the presentation, I would very quickly want to thank every member of the T+1 implementation cycle committee. We would not have gone to where we are, would not be where we are today if not for the support, the commitment, and the responsibility that has been shown towards this project. I just want to acknowledge that and to say thank you to every member of that committee and the community that they represent. Thank you very, very much. So very quickly, I will go into the presentation. This is the outline. I will start with the introductions and then we'll speak about what the limitations are to the current T+2 cycle, what's the rationale for transitioning to a T+1, and then what are the expected changes that we would see in the market structure as we move on. We would also have an overview of the target T+1 operating model, the technical gap analysis, look at our technology and infrastructure readiness, and then also speak about the trade default mechanism, how we would manage risk under T+1, how much of the market readiness and stakeholder engagement has been done. We would also look at the implementation timelines and key milestones and the expected benefits and success metrics as we go live on May 29. The T+3 to T+2 implementation was a transition phase last year, November 28, because the intended move was a T+3 to T+1, which had been communicated to the market, but it was necessary that this was staggered in such a way that the market moved to T+2 last year. And at that time, the communication was clear that the T+1 was going to be something that was necessary for 2026. And even the timeline had been communicated at that time. And so we are at that point where we are actually now moving to T+1 as part of that intended move from T+3. Again, a lot of the speakers, I know that Mr. Akeredolu also had emphasized this around what the global momentum is. The NGX also had done that. Where is the world moving on to? And we can see that by 2027, 60% to 70% of the global market would be at T+1. And we can see here from this slide that China, India, the US, Canada, Mexico, Pakistan have all transitioned to T+1. So there's clearly a global momentum, there's clearly a global drive towards T+1. Now, what are the limitations to the current T+2 cycle? While we agree that there's been a lot of improved efficiency as the market moved from T+3 to T+1, and that the investors' confidence has been strengthened regards the Nigerian market, but there are inherent limitations that we must not overlook. We still have continued exposure to settlement and counterparty risk. These risks are usually driven by delayed settlements. The longer the settlement cycle, the higher the probability and the risk of exposure to settlement and counterparty risk. There's also the delayed access to capital for investors. When you have a lengthier settlement cycle, then the investors will not have access to their capital because it takes a longer time for this capital to be available to them from the market. And again, like I'd spoken to in my previous slides, there's a reduced alignment with global markets when 60 to 70% of the global market is working towards a T+1. So it is necessary that also the Nigerian market ensures that there's that alignment with global market standards. And so this clearly speaks to the rationale of why we need to move to a T+1. Shortening the settlement cycle, definitely and clearly that I explained, would reduce systemic and operational risk in the markets, because again, the shorter the cycle, the less likely the risk. and also the enhanced liquidity. Faster settlement will allow investors, will allow institutions to redeploy capital more quickly, and this would impact positively on the overall market liquidity and capital efficiency within the market. And of course, the global alignment, which I cannot overemphasize in this presentation. And again, there's also the fact that as we move to T+1, what we are also doing is also looking at current market inefficiencies and working with the Nigerian market to ensure that there's improved infrastructure, automation within regulatory framework. So this is part of a broader effort to modernize the market and highlight these inefficiencies as they exist, correct them as may be necessary, and ensure that the market has better improvement, better efficiency, and better automations. What are the changes that have happened to the market structure? As had been stated before in previous presentation by the NGX has extended its trading hours from 2:30 p.m. closure to 4 p.m. closure. So there's been some impact in terms of trading hours. The post-trade allocation window, which was a 2 hours and 30 minutes window, has been reduced to 30 minutes. Also, contract note issuance for dealing members, from dealing members to clients, the mandate is now to issue those contract notes to clients within an hour of market closure. I'm very happy to report that this is something that is already live. Dealing members are already issuing this contract notes to clients within an hour of market closure, even after the extension of the trading hours by the NGX. And also reporting timelines, CSCS will ensure that settlement reports are issued within 30 minutes of completing post-trade allocations, which is basically 30 minutes after the closure of the market at 4:30, including post-trade allocation, and before 5 p.m. This is the overview of the target T+1 operating model. What will T+1 actually look like when we go live? From what we can see on these slides, on T+0, from 9 a.m. to 2:30 p.m., you have all the exchanges trading. The exchanges are open for trading. Dealing members are executing mandates. There is trade execution and matching on the exchanges from market open to market close. At 3 to 4 p.m., certain exchanges will be closing and they will send in their market closure and trade confirmation to CSCS. Again, this is on T+0. Now for exchanges like the NGX, the post-trade allocation window will open at 4 p.m. and close at 4:30 p.m. And post-trade operational processes are completed, and CSS will generate settlement reports to various parties and stakeholders within the market. At 5 p.m. on day T+0, CSCS will send trade advice to stakeholders. This trade advice is what we call a for your information settlement advice. Again, why we refer to it as for your information is, one, it's a notification, and we believe that if there is any advice subsequent to that, this settlement advice can and will be updated. On T+2, the expectation is that settlement banks would have reviewed the FYI settlement advice that they had received, and they would review this against account positions of dealing members and investors if it's a direct cash settlement, and escalate any unfunded position on or before 12 noon. That's the expectations from settlement bank. They are supposed to confirm the account position in respect of the cash settlement that has been stated on the notification in the FYI settlement advice, and confirm to CSCS if there is any unfunded position. Between that 12 noon and 2:30, CSCS will engage both the bank that has reported and the defaulting participant to ensure that obligations are met. Any account that remains unfunded by 2:30 p.m. is deemed to be in default. And so it is important that settlement banks notify the CSCS in due time before 12 noon, so that whatever remediation measures that needs to be taken can be taken before 2:30 p.m. At 3 p.m., CSCS will send trade advice to stakeholders. This is a final and irrevocable settlement advice that will be sent to all the stakeholders. And so it is important that escalations of default or unfunded position or potential default and unfunded positions are communicated early enough, because again, by the time the final settlement advice is sent to the market, that will be the settlement on T+1. CSCS would also advise NIPS of this settlement advice by 4 p.m. and by 5 p.m. net cash and securities settlements will be processed on T+1. We've also looked at what the technical gap analysis would be. What this means is that what will be the changes, what will be impacted in terms of this change. And so what we have highlighted here are 15 processes that we think are critical to this process, and what the impact will be for them in terms of will there be an activity modification? Will there be a change in the process? Or would it just be a change in the timelines? Whether there's even any change at all, whether in process or in timeline. Items 1 to 5 listed here, there are no changes in terms of what operates now under T+2, whether in timeline or in the activity or process modification. Trade execution will go on as we have it today in T+2. Trade matching will go on as usual. Preparation of trade file, trade confirmation, exchanges, and will send closure advice as we'll have it. Again, I'd spoken to the extension of the trading hours, but apart from that, there are no changes in terms of activity modification or timelines for processes 1 to 5. Now, for the other processes from 6 to 15, we have modification not in terms of the activity or the process, but in terms of the timeline. The settlement report generation, the end of trade settlement reports generation, the timeline has changed for that I had stated. The FY settlement advice will go on T+0, which today is a T+1. The trade default mechanism also has changed in terms of the timelines, because again, notification is going to happen, it's expected to come in from the banks at 12 noon on T+1, which is different from what we have today. And the final settlement advice also happening on T+1. The NIPS settlement advice happening on T+1, again, as different from what we have on T+2 today. Net cash settlement would also occur on T+1, security settlement on T+1. It is also expected that the settlement banks will process cash transfers and dealing members will also process cash transfers on T+1. Post-settlement reporting, which today on a T+2 cycle is done at T+3, will happen on T+2. Post-settlement reporting, especially to the registrar community, will be on a T+2 basis as against T+3 that we have it today. So this slide speaks to the changes across the various 15 processes that we have highlighted. And as I've said before, we would note that there will be no activity modification. What we only have are timeline changes. How ready are we from a technology and infrastructure standpoint? We would want to state that based on feedback that we had received from the community, there had been a lot of work done, and we are happy to note that contract notes issuance within 1 hour of market close is already live within the market. And so that is something that is available, and speaking to about noting the inefficiencies in the markets and trying to resolve them as we move forward. This is one major move, one major achievement. I dare say that we have achieved for the market, such that within the market, within 30 minutes to 1 hour of market closure, contract notes are advised to participants. And there's also the potential for direct transmission and interface through APIs. I'm speaking to the next point. The APIs are available to enable real-time processing. There are also enhancements around reporting within CSCS. Another focus is also that we are also going live on participant integration, which is in most instances we are already live. We have direct integration from the brokers to the exchanges, to the registrars, every participant. There's a direct integration with CSCS. We leverage on standardized protocols and interface. So there's already operating in the market, even under the T+2, seamless data exchange and operational alignment. And also, I'm also very happy to announce that there's been an industry-wide testing of the T+1 process, and it was very successful. We had 100% success rate on that. Thank you. In terms of risk management, how would it look like? How would we manage defaults? I'm very happy to say that in the 25 to 30 years of CSCS existence, we've never had to have a default position in the market that was unresolved, and there's been no failed trade position. So on T+0, you would have execution of trades on the floor of the exchange by dealing members, and these trades will be matched and transmitted to CSCS. Again, CSCS will send notifications to all the members, the custodians and settlement banks and related parties to the transaction. Now, in terms of escalation of unfunded position, settlement banks are expected to escalate unfunded cash settlement positions to CSCS on or before 12 noon on T+1. That is very, very important to note. CSCS would engage the bank and the defaulting participant to meet its obligation. Any unfunded account as at 2:30 p.m. on T+1 is considered a default, and the final settlement advice is sent by 3 p.m. CSCS will send its news report to NIPS. Will send settlement report to NIPS by 4 p.m. and this will be processed by 5 p.m. Based on the available NIPS window of 4 p.m. Then CSCS proceeds with the default settlement process, which involves the defaulting member being cautioned in accordance with the settlement framework, and the bank would appoint a broker, a dealing member to whom the cautioned securities will be transferred to sale to cover their position. There will be stringent measures for such defaulting circumstances. Penalty and fines for trade defaults remain stringent. In the probability or in the event where there's a differential in price after the bank has appointed a broker to sell and the actual exposure of the bank, the settlement guarantee fund is available to cover such price differences. The trade settlement governance framework has also been revised and advised to all members of the market. There would also be regular reconciliation between CSCS and post-trade members as is currently done today. Again, this is an automated process based on our data exchange and automated interface process. Also, compliance reporting as is currently done to the SEC would continue, and then the pre-funding rule would remain to mitigate failed trades. The pre-funding rule states that the investors in the market should actually pre-fund their trades on T-1. That is very important at a minimum, and that rule remains even under the T+1 market cycle. In terms of market readiness and stakeholder engagement, like I stated, we have done a successful test within the test environment, and we also want to reiterate that it was quite successful. And this test was a full cycle test from the exchanges to CSCS, the custodians, the brokers, the registrars. Everybody was involved. There was also a high volume stress testing and high value trades done as part of the test. And this test was clearly a major achievement within the committee's expectations. In terms of our market readiness, we have, like this webinar that we're having now is part of the market-wide sensitization There's also FAQs. We have a website that is updated regularly in terms of the work that is being done towards T+1. There are regular steering committee meetings, very engaging meetings where feedbacks are received, where issues are resolved, where inefficiencies are highlighted, mitigated, risks are also mitigated. Again, the target for this is literally everyone within the market, institutional investors, exchanges, individual investors, everyone is involved. Also, to quickly state that there would also be another webinar after this webinar before go live on May 29, again, as part of the market-wide sensitization that the committee is working on. This slide speaks to the key milestones in terms of what we intend to achieve, what is the roadmap to May 29. The first item here speaks to updating the existing settlement framework. This had been updated in February. We also received feedback from the members of the markets in terms of certain aspects of this settlement framework. And based on that feedback, again, this framework was reviewed further and updated to align with the expectations of market participants. And again, want to also thank every participant that has been very vocal in terms of changes that are required, in terms of inefficiencies that are highlighted and are being corrected, just to also state the appreciation on behalf of the committee for sections of the market that have been very vocal around the need for certain changes, and that has driven these changes, and we have gone live on these changes. So say thank you very much. We've also done a gap analysis. This gap analysis was done based on the different participants or different representation in the steering committee, and each of these gap analysis, whatever was noted as a gap was resolved very quickly. Again, huge thanks to the steering committee for being very supportive, one, in highlighting these matters, and secondly, in working with the CSCS and working with other stakeholders to close this gap from an operations and infrastructure point of view. Also, changes have been done in terms of system upgrades. I've spoken about the contract notes, for example, that have been delivered within 1 hour after trade. SOP upgrades, standard operating procedure upgrades have also been done. We've also had validation testing and change management done between the month of March till date. Market engagement, like this webinar, is part of the sensitization sessions that we have been pushing through. Implementation again is May 29. That is go live day. And then we expect that in June, we would share a post-implementation report, just like we did when we transitioned to T+2. What are the expected benefits and success metrics in terms of this? We expect that there will be efficiency gains, and some of these gains were even seen before going live in terms of the changes that have been done in terms of process, in terms of infrastructure, in terms of automation. We also see that part of the benefits is improved market liquidity and turnover. We expect that there will be more interest in the capital market based on the shorter settlement cycle. We expect more liquidity, we expect more turnover, we expect that the market will be more endearing to maybe probably different segment or of the community who would prefer a shorter settlement cycle. We also expect to see enhanced global competitiveness, especially as more than 60 to 70% of the global market is moving to a T+1 cycle. And we would also ensure that we keep monitoring key performance indicators to measure the success of this transition. In terms of closing remark, I want to quickly state that it is important that as a market, the Nigerian market is a pre-funded market. It's important that we guarantee complete adherence to the pre-funding rule. I noted a question before my presentation in the chat room to say that for certain sections of investors, the pre-funding rule may be a challenge. I think what is most important, apart from adhering to the pre-funding rule in the Nigerian market, is to ensure that there is no default in terms of settlement. So that is very, very critical, and that is something that must be emphasized. And then we must also maintain commitment to readiness and continuous adaptation. We intend to continue to improve the process. Like I have stated before, we value the very, very vocal feedback from the different sections of the market, and we would be ready to make changes, and we maintain a commitment to that readiness. And we also want to just encourage every member of the market, every stakeholder group, to also share in that commitment for continuous adaptation. And then we would also collaborate actively towards stabilization, and during a stabilization period post go live. And I believe very much that together we will make it happen. T+1 on May 29. Thank you very much. That will be the end of my presentation.
Thank you so much, Mrs. Onomeka-Molafe. That was a very clear and practical overview of the readiness activities and next steps. Perspective to the subject holders, Agama, Director General of the Security and Exchange Commission. Dr. Agama, you have the floor, please.
Okay, great. Thank you very much for having me today. It is indeed a pleasure to be here again. For me, it's a continuation of a process we had started, and I am glad to note that the process is going on well. So I'm actually genuinely honored to deliver this keynote address at what I consider one of the most consequential corporate capacity building events on the Nigerian financial calendar. It is with profound gratitude to the Almighty and with a deep sense of duty to the Nigerian people that I stand before you this morning. Now I'm sitting because it is virtual. We gather not merely to mark a technical adjustment, not to celebrate a procedural reform. We gather to bear witness to a moment when the architecture of our capital market quietly but unmistakably takes a step into the future. Today, we announce the transition of the Nigerian capital market from a T+2 to a T+1 settlement cycle, taking effect on Friday, 29th of May, 2026. To the casual observer, this may sound like an arithmetic of days. To those of us who have labored in the engine room of this market, it is the arithmetic of trust, the geometry of confidence, and the calculus of competitiveness. Indeed, if you have been part of our Capital Market Master Plan 1.0, you will know that this is an important ingredient in the Capital Market Master Plan that expired in 2025. Settlement is the heartbeat of any capital market. It is the moment at which a promise becomes a possession, at which a trade becomes a title, at which intention becomes ownership. To shorten that cycle is in a very real sense, to shorten the distance between a Nigerian investor and our wealth, between an issuer and his capital, between an economy and the world. For 3 days to 2, from 2 to 1, and in time to 0. This is not the language of incrementalism. It is the language of transformation. Permit me to set the journey in its proper context. For decades, the Nigerian capital market operated on a T+3 settlement cycle. On 28 November 2025, after extensive engagement with stakeholders, comprehensive readiness testing, and a deliberate strengthening of our post-trade infrastructure, we successfully transitioned to T+2. 6 months later, we stand on the threshold of a T+1. This pace is intentional. It is neither rushed nor reluctant. It is the disciplined cadence of a regulator that understands two truths simultaneously: that markets must evolve to remain relevant, and that evolution without stability is merely turbulence wearing a new name. We choose a phased approach because we are stewards of the savings of pensioners, of the retirement contributions of civil servants, of the investments of widows and orphans, of the trust of foreign institutional investors who must be persuaded every single day that Nigeria is worth their confidence. A reckless reform, therefore, betrays that trust. A measured reform ends it. Indeed, I am proud to serve under this government, a government of reforms, positive reforms that are touching Nigerian lives. His Excellency President Bola Ahmed Tinubu has set the ball rolling, and for us that are stewards, we must take the baton. And so the Central Securities Clearing System, having deployed the technological foundation with the Nigerian Exchange, having tested its systems with custodians, brokers, registrars, and settlement banks, having undertaken industry-wide readiness exercises, we now move with confidence to T+1. What T+1 truly means, let me speak plainly about what this transition delivers. First, it compresses risk. Every additional day between trade execution and final settlement is a day in which the counterparty risk lives, breaks, and threatens. By having the settlement window, we materially reduce the probability of failed trades, the exposure of clearing members, and the systemic vulnerabilities that lock in the gap between agreement and finality. Second, it liberates capital. Under T+1, an investor who sells shares on a Monday will receive value on a Tuesday. That is not a bureaucratic detail. That is liquidity placed in the hands of Nigerians one day faster. Liquidity that can be reinvested, redeployed, or simply enjoyed. Multiplied across millions of trades, this is structural acceleration of capital velocity in our economy. Third, it sharpens our competitiveness. The world's leading markets, the United States, India, Canada, Mexico, have moved to T+1. European Union and the United Kingdom are on the path for Nigeria to remain a credible destination for global capital. We cannot afford to be a generation behind in settlement infrastructure. Today, we close that gap. Fourth, and perhaps most importantly, it builds the foundation for what comes next. T+1 is not the destination. T+1 is the disciplined runway from which we shall, in due course, take off into T+0. Same day settlement, when the entire ecosystem is ready. We certainly will not rush this. We have already confirmed that the technological foundation exists. The remaining work is operational, behavioral, and institutional. We will definitely get there. This transition does not stand alone. It is one movement in a larger symphony of reforms reshaping the Nigerian financial landscape under the President Bola Ahmed Tinubu regime. On 7th April 2026, the FTSE Russell announced the reclassification of Nigeria from unclassified to frontier market status effective 21st September 2020. This is not a small thing. After our painful exit in September 2023, occasioned by foreign exchange repatriation challenges that frustrated international institutional investors, we have walked the long road back. We have done the hard work of reform. We have rebuilt the bridges that were broken, and the world has noticed. Independent analysts project that this reclassification alone could attract benchmark-driven inflows in the conservative range of 840 million to 1.04 billion United States dollars into the Nigerian equities. Our market capitalization already crossed the historic mark of 130 trillion naira and continues to rise. Nigerian flagship names, MTN Nigeria, Dangote Cement, GT Co, Zenith Bank, Seplat Energy, Nelson Nigeria, Bua Fruits, Nigerian Breweries are once again on the radar of global passive and active investors. Now consider what this transition to T+1 does in that context. International investors evaluate markets along precise criteria: the integrity of governance, the depth of liquidity, the predictability of post-trade processes, and yes, the speed of settlement. A market that re-enters the FTSE Frontier Index in September with a T+1 settlement cycle already in place is a fundamentally different proposition from a market that returns burdened with legacy infrastructure. We are not merely returning, we are returning upgraded. We are not the Nigeria the world left behind, we are the Nigeria the world is coming back to. Let us be clear about the architecture in which this reform is embedded. Nigeria's sovereign credit rating has been upgraded. Nigeria has been removed from the Financial Action Task Force gray list. Inflation has moderated. The Investment and Securities Act 2025 has provided the most modern statutory foundation our market has ever possessed, embracing virtual asset service providers, commodities, and a strengthened investor protection regime. Operator registration is moving fully electronic. A harmonized corporate governance reporting template is being deployed. The Investor Protection Department of this commission stands operational. Each of these reforms on its own is significant. Together, they constitute a coordinated reconstruction of the credibility of the Nigerian capital market. Settlement reform is the connective tissue that binds these reforms into a single coherent narrative. A narrative that says clearly and without apology that Nigeria is open for serious capital, governed by serious rules, and served by serious institutions, and moderated by serious infrastructure. Our brokers and dealing members, the compression of settlement timelines demands the elimination of operational slack. There is no longer room for manual workarounds, for late confirmations, for process built on assumptions of forgiveness. Your systems must keep pace. Your people must keep pace. Your culture must keep pace. Hence, your capital must be good enough to deal with this. To our custodians and registrars, you are the silent guardians of investor entitlement. T+1 places you at the center of a tighter choreography. We expect and will enforce the highest standards of automation, accuracy, and accountability. To our settlement banks, liquidity management under T+1 is not what it was under T+2 or T+3. Funding circles, foreign exchange settlements, and intraday liquidity arrangements must be rigorously calibrated. The Commission, in concert with the Central Bank of Nigeria, will continue to monitor closely. To our institutional investors, pension funds, asset managers, insurance companies, this reform expands what is possible. Faster settlement means faster portfolio rebalancing, sharper alpha capture, and more efficient cash management. We urge you to seize this advantages. To our retail investors, the ordinary Nigerian who has placed savings in our market, this reform is ultimately for you. It means your money works harder for you. It means your sales reach you sooner. It means the market belongs to you in a way that is more immediate and more real than ever before. And to our international investors, Nigeria is listening. Nigeria is reforming. Nigeria is delivering. Bring your capital, bring your expectations. We intend to meet both. Let no one mistake this moment for an arrival. T+1 is a station, not a terminus. The Commission has made clear, and I reaffirm today, that our phase strategy contemplates eventual movement to T+0, same-day settlement. The technology is ready, the infrastructure is ready. What remains is the careful sequencing required to ensure that pension funds, asset managers, foreign portfolio investors, and retail participants all transition without disruption. We will not be reckless, neither will we be timid. When the ecosystem is ready, we will take that final step, and Nigeria will stand among the most settlement efficient markets in the world. Distinguished ladies and gentlemen, history is rarely made in a single dramatic gesture. More often, it is made in the patient accumulation of disciplined choices. Choices to reform when reform is hard, to modernize when modernization is contested, to lead when leadership is lonely. We take our cue from our president, President Bola Ahmed Tinubu, who has decisively made reforms in this country that nobody will ever doubt. The choices by this commission, by our sister regulators, by our market institution, and by the Honorable Minister of Finance and Coordinating Minister of the Economy, and the government of the Federal Republic of Nigeria, ably led by our president, are choices of that kind. On May 29, 2026, when the bell rings on the first T+1 trading day in Nigeria's capital market, it will not be a bell announcing the close of an older day order. It will be a bell announcing the opening of a new one, a Nigeria more efficient, more transparent, more globally integrated, and more deeply trusted than the Nigeria of yesterday. This is the work, this is the movement, and this is the moment. And by the grace of God, and through the resolve of the Nigerian people, this is only the beginning. I thank you most sincerely for an opportunity like this and for being able to be part of history. Congratulations to the Nigerian capital market. Congratulations to the CSCS. And congratulations to the Federal Republic of Nigeria. God bless you. Thank you very much.
That is a very instructive perspective. Thank you very much, sir, for your remarks and continued leadership. We appreciate your guidance. Thank you so much, sir. Now, we are moving into the Q&A session. Please keep your questions coming in. We'll continue to take that. So we're going to check the chat box and we'll take the first question. So hold on. So we have a question from Joe King. So the question goes, and I'm going to, I think the question is in two parts. So I'm going to direct the first part to Mr. Jude, Mr. Jude NGX, and the second part to Mrs. Onome Komolafe. So the first question, brokers sending contract notes by 5 p.m. on the T is going to be very critical for foreign investors. So brokers, no, let me take it again. Brokers sending contract notes by 5 p.m. on the T is going to be very critical for foreign investors to be able to fund on T+1. Has this already been successfully implemented? And if yes, how is it going to be tracked to ensure that we are meeting this requirement? What will happen to brokers that don't meet this deadline? Do you want to take that, Mr. Jude?
All right, thank you. Can you hear me?
Yes, we can hear you.
Okay, so that is part of the work that has been done to ensure that the market operators align themselves with a process that will allow for a seamless transition. And having tested that, we confirmed that yes, the technology to do that is available. Our brokers operate under a minimum operating standard, and that allows them to work with the right technology to be able to issue contract notes when the market closes. Yes, really time extension makes it even easier for them to be able to produce contract notes before the time elapses that's required for this process to be seamless. Thank you.
Thank you very much. But that part of how would they be tracked? I'm not sure that is very clear in terms of when a broker has defaulted.
So the way it works is like we have trading license holders that are over 103, and the contract notes are sent to the clients via technology. Now, because of the minimum operating standard, so there's a process flow that is required. So that makes it imperative for the trading license holders to adhere to that trading, the minimum operating standard. So the risk-based supervision that the RECO does, which is our regulatory arm, the broker-dealer regulation community, anybody who does not operate within the minimum operating standards will certainly be penalized. Like they say, people don't obey the laws. People obey the laws not because they want to obey, but because of the consequence of not obeying. So there will certainly be a consequence for missing this timeline, and that is what I believe our broker community will ensure that they comply. We've seen a high level of compliance. The market has been running seamlessly. Other initiatives have run seamlessly, and we believe that this will not be an exception. Thank you.
Thank you so much. Thank you. So the second part of the question is to Mrs. Komolafe. So this has to do with the operation framework. So the question is, the operation framework points 2.3.6. It advises the dealing member or trading license holder must ensure that the cash settlement account is pre-funded for trades. How is this going to work for foreign investors, as we will not be able to pre-fund? We'll only be able to fund on T+1 late morning to midday at the very earliest. I think you've also answered this in your presentation, but you can just go ahead. Thank you.
Thank you very much. Yes, and I did refer to it, Safina, when I was presenting. The guidance and the rule from the regulator, the SEC in the market, is that Nigeria is a pre-funded market. What that means is that you should make funds available before T+0, which is the trade date. While we understand the particular intricacies of certain investors not being able to pre-fund, mostly around foreign exchange valuations and all that, I also want to state that what is also very critical in this process is that you do not default on your trades. So if there are instances where you cannot pre-fund, you should ensure that you fund before the cutoff time of 12 noon on T+1 to avoid escalations from your settlement bank. Thank you.
Thank you so much for that. So there's also a question here. The question is actually more of comment-to session as well. Comments and also a question. And that is to the CSCS MD, Mr. Chantilly. And Onome, you can also support as well. So the question is around the automation. So the first comment is, although the automation across the value chain has improved, but it is still not at the level required for a successful T+1 settlement cycle. In order to have a fully workable settlement cycle with no risk there, there must be full end-to-end connectivity with no manual intervention across the value chain. So the question is, for these investors and every stakeholders to benefit more from this automation around minimizing operational risk and improved timelines, that is there a way, so they are pleading, that is there a way whereby the CSCS and the SEC will actually maybe pause a bit briefly to see if the full automation can be put in place before the go-live date of the T+1?
Okay, Safina, please, can I go ahead and take it? I'm not sure Mr.
Okay,
Chantal is available.
Okay,
Sir, are you available? Okay, so I'll just quickly go ahead and take it. So in terms of what we had done and which I had stated in my presentation is that we had done gap analysis across the market. We had highlighted areas where there was need for automation, and the various stakeholders have also emphasized those gaps. And what we have done in the last 4 or 5 months is to ensure that those gaps are closed. Do we have a full automation across the market end to end, like what we would want? The answer is no. But do we have an improved automation across the market than what we had under T+2? Yes. Do we have an automation that can support a movement to T+1? Yes, we do. Again, based on the feedback that we had received from the market, what is critical to the market? And I would also want to state that in terms of automation and technology, I think that it's a process that has to be ongoing. Again, not just because there's a gap, but there might be new requirements, there might be need for changes. And so the process automation as an ask is an ongoing an ongoing request that will be met continuously. But are we ready from an automation point of view? Yes, we're definitely ready. Under T+2, we had APIs across the market. We had integration for every stakeholder in the market. We have brokers portal. We have registrars engagement portals. We have direct interface with the exchanges. We have detachment processes that are self-service for the custodian and broker community. We've improved on this in terms of reporting. Again, just to make sure there's an alignment for T+1. To answer that question very directly, we do not see any major gap from an automation process, and we want to thank the community and every member of the capital market for highlighting inefficiencies before now, and which we have dealt with. And are we ready based on current automation to go to T+1? The answer is most definitely we are. Thank you.
Thank you so much. So the next question, this will be to Mr. Juchimika. Thank you for the presentation. Transition from T+2 to T+1 within a short period of time is impressive move. What are your plans regarding introduction of derivatives like options?
All right, thank you very much. That's a very good question because the structuring of the settlement cycle is all part of the broad market strategy. New products, using technology to drive products will also be part of the growth strategy of the NGX. So for now, we launched the index futures. We have 4 index futures that are listed on the exchange. And we're doing a lot of stakeholder engagement, capacity building for investors, to be able to even understand the derivatives market properly. The next phase will be to go to single stock futures, which will really help retail investors to de-risk their portfolios, especially in line with the pricing that we're seeing at the moment. It will be good for them to have a tool that they will use to de-risk the market. Obviously, after that, we can then go into options and other kinds of services. Thank you.
Thank you so much for that. Thank you. So I'm taking the next question. Do we have the required efficiency and infrastructure to tackle fraud in T+1? So any of the speakers can please answer that. Thank you.
Sefina, if you would allow me to do that, if that's
Okay.
fine.
Yes, please.
So today we have processes that are in place around managing risk for the capital market, and very proud and happy to announce that we've never had any challenges around these processes. And what this means is that even as we move on to T+1, we've also had to review those processes. Again, part of my presentation was to speak to the default management framework and also other processes that we have reviewed, highlighted gaps and closed those gaps. So how are we prepared for the probability of fraud in T+1? I will say better than we were prepared for it under T+2. Thank you.
Thank you so much. So, Madam Onome, I think this is also for you. You state that the settlement banks are expected to be in a position to review positions by 12 noon latest. Are they ready for this? We are not getting comfort from the bank's current positions that they will be ready.
Okay.
Did you get it?
Yes, I did. Part of the engagement we had done, first, I want to say that the settlement banks are fully represented on the steering committee of the T+1 implementation cycle, and they have been part of the process from day one, as they were in the movement to T+2. Secondly, we've also engaged them as a community to also highlight the need for a very structured and disciplined process around funding positions, and that's very clear to that community. If to answer again directly, are the settlement banks ready for those escalations? I believe very strongly they are. It's also important to note that they actually get a notification on T+0 around those positions. So they actually have a notification a day before, and they can follow through, and they expected to escalate before 12 noon. And also there's also the 12 to 2:30 window wherein such escalations can be dealt with. So I would want to say very clearly that the settlement banks are more than prepared for this move to T+1. Thank you.
Thank you, Mrs. Kobalafe. So there's another question. when can we expect or receive an official communication from CSCS with the settlement deadline? And I think this has already been shared by CSCS about a week ago, but I don't know if you have any comments to that, Madam Olome.
That has been shared, and we also have a website where you can, as part of our website, where you can go for updates on the implementation of T+1. So every information you required is actually placed there. But again, we had done a circulation to the market, investors, institutionals around the T+1 about a week ago, like you said, Safina.
Yes. So I would still have you here. This question is also to you. The detachment CSCS website should be looked into, especially for custodians, to avoid unnecessary delay, to avoid brokers not accessing the stocks they are meant to trade on. So just general question around CSCS looking at the detachment website, the portal, to ensure that there won't be any unnecessary delay since we are moving to a T+1.
Yes, thank you very much. Again, the detachment process was one of those processes again that we received feedback around inefficiencies and which we have resolved. And we're happy to receive any further feedback if there are further inefficiencies or if those inefficiencies have not been corrected. We understand that the detachment process is critical to the T+1 because without the detachment process, the trade will not even happen on T+0. So it's almost like there will be a failure even before trade. So this is very important to us, and we have a portal for the detachment process. We have API-enabled interfaces available to the market for the detachment process. But again, if there are issues around efficiencies or effectiveness of that process, we're happy to take those feedbacks and make those corrections as need be. But that process, we've received this feedback, that process has been reviewed and improved upon very, very much, and we do not expect any challenges from that process. Thank you. Safina, I'm not sure I can hear you any longer.
Hello, Onome. It seems as if Safina is having a bit of technical issues right now.
Okay.
So, yes. I don't know, maybe if you want to go ahead with the closing remarks for us. Safina is not on, she's out of the Zoom now. Thank you.
Thank you very much, Ogo. And I want to also thank everyone that has been part of this process. It's a process that is beneficial to every one of us. Very huge thanks to the Director General of the Securities and Exchange Commission, Mr. Momotimi Agama. Also thank you to the Chairman of the CSCS, Mr. Timi Popola. Also a huge thanks to the NESD MD CEO, the LCF is CEO, and also thanks to Mr. Jude Chemeka for also being part of this presentation, and for everyone who has logged in today. We want to say thank you for the questions that have been asked. Even the ones we've not responded to, these questions will be looked at and we would take them as input. We are very big on feedback. We value feedback because again, that is a mirror wherein we can see our inefficiencies and work on them. And as we move on to T+1 on May 29, we appreciate every collaboration and every effort that has been made towards the success of May 29. Also want to do a special thank you to members of the T+1 implementation cycle committee, the steering committee. Want to say very big thank you to you for your sacrifice, for your commitment, for the resources that you've put towards the success of this project. Thank you very much, and thank you to everyone, and do have a very good day ahead. Thank you.
Okay, thank you very much, Onome, for your closing remark. And also, I would like to thank all the speakers for joining. Thank you to the attendees. From CSCS, we wish you a very good day. Thank you.